Well, what a year. As inflation notched multi-decade highs and the Federal Reserve raised interest rates at a pace never before seen, the traditional 60-40 portfolio here in the US locked in its worst year of performance since 1937. So where do we head from here? Well, as we've spoken to individuals and gathered intelligence, we see two primary arguments from the retail investor base. The first is that since interest rates are still slated to rise in 2023, bonds are unattractive at this juncture. The second is that with a looming recession, there will likely be significant earnings pressure on equities next year, making them also unattractive. We think these two stances are far too generalized, and we'll seek to unpack them in this quarter's Quarterly Edge. The three themes this quarter are: 1, asset allocation, stocks versus bonds, in which we'll talk about why we think bonds are looking more attractive than stocks than they have at any point in the last decade. Second, on the fixed income topic, we'll talk about why we think it's prudent to focus on what we're calling blue chip debt at this juncture. And then finally, we'll talk through the equity equation and discuss while we do think consensus earnings estimates are a little too high, that doesn't necessarily mean that the S&P 500 will end the year lower. And further, we'll talk a little bit about the inflationary tailwind that could be provided to the equity markets. Thanks for watching, and I hope you tune in to the more detailed videos to follow.